Welcome, welcome. All right, we are starting a new lesson today. We're moving past the credit cards, the intro to credit cards, and we're doing credit card statements now. Woo! Now this lesson, oh, this would be lesson six, shouldn't it? Well, this lesson should be lesson six. Sorry, I should fix that. And we're doing day one, and it's credit card statements. So we're learning new stuff today, new learning targets, all that kind of good stuff. There's only actually 3 days to this lesson, and then after that, we're done with the unit two consumer credit, and we're moving on probably to automotive ownership. All right. So here's your learning target today. I can identify and use the various entries in a credit card statement. All right. I can identify and use the various entries in a credit card statement. The idea here is we're going to get you familiar with all the little pieces and gears and gizmos in a credit card statement. Okay, new lesson, new vocab, right? We got to talk about a billing cycle. What's a billing cycle? This is the cycle by which the credit card company uses to assess your finance charge. Remember, we were calculating finance charge based on billing cycles, usually 30 days. Then there's the credit card statement. This is a little piece of paper you get in the mail that has all your purchases on it, right? That you had on that credit card. One of the advantages of having a credit card, remember, is that it kind of has that automatic feature of once a month you get a statement online or in the mail with all your purchases there. Your account number, that is your account number. This is actually what's used to make purchases. So you don't want to be giving this number out, to the public. You don't want to be printing this on Instagram or anything. There's scams out there where it's like, what does your credit card number spell? And people who are silly enough to do that, can get their credit card number stolen. Credit line, credit line. So this is how much credit the credit card company is extending to you that you could potentially borrow if your balance already is zero, right? So your credit line, they might extend to you a five. Well, usually your first credit card, they'll extend something like $500 as a credit line, and then as your credit score goes up, they'll feel more and more comfortable giving you more and more credit. Then there's this thing called available credit. That's how much of the credit line you still have available to you, right? If you're given a $500 credit line and you've already spent $100, then you only have $400 left as available credit. A billing date, we'll talk about that. Payment due date, that's when the payment is due by, right? They have to receive that payment on that date. If you mail it on that date, sometimes they'll be okay with that if it's postmarked. Other times not. So you want to make sure they get their payment by the due date. Transactions are all the things you bought or sold over the course of that month. uh, Debit, credit. All right, so debits are the things that are debts that are added to how much you owe, whereas credits are payments that um, relieve how much you owe. We'll talk about that too. Previous balance, right? We talked about how credit cards usually have a revolving balance, is what it's called. So if you didn't pay off your credit card from last month, it carries over to this month. That's that previous balance, is that amount of money that's carrying over from last month that you hadn't maybe paid off yet. Payments and credits, right? So if you make a payment on your credit card, I want you to remember that this is important. If you make a payment on your credit card, you need to think about that as this lowers how much you owe. This lowers how much money is on your account. If you're making purchases on the account, this is increasing how much you owe. If there's a finance charge on your account, it increases how much you owe. If there's a late fee, it increases. Everything increases how much you owe, except for the payments and credits. All right. Let's see. New purchases. New purchases is basically if you add up all the purchases you made in a given month, that would be equal to the new purchases. Late charge. Yes, indeed. If you fail to pay that minimum payment, which we'll talk about in a second, you will be assessed a late charge. If they don't receive their payment by the payment due date, they'll tack on a late charge. They'll also often increase your APR and interest rate as well. Finance charge. If you do not pay this credit card off every month, you will be assessed a finance charge based on your average daily balance, which we did in the last lesson. New balance. So your new balance is basically all your We'll talk about it. It gets complicated, but it's your previous balance minus any payments or credits plus the finance charge plus your new purchases plus late fees. All right, we'll talk about that in more detail. Minimum payment. There's always going to be a minimum payment if you owe anything at all, right? Usually that minimum payment is about $20 in most cases. So you need to pay at least $20 per month. Credit card companies love it when you pay only the minimum payment. It makes them the most money off you, and it'll take forever to pay off a debt if you're only paying that minimum payment. But they want to see at least that minimum. Average daily balance. We spent a lot of time in the last lesson calculating average daily balances. Then the credit card company essentially takes an average of each day's balance, divides that by the billing cycle, usually 30, to find the average daily balance you held, and they use that number to assess your finance charge. Number of days in the billing cycle, usually 30, could be less if you have poor credit or very low FICO score or something. APR is annual percentage rate, and then monthly periodic rate. Remember, you take that APR divided by 12, that turns it into a monthly periodic rate. Sorry, I can't mute myself, I don't think, when I'm doing these. All right, so you want to put your name in right there. Okay. These are the topics. Oh, moving on to a different unit. We'll get new topics soon. Let's see. Yeah, we did cubic regression. We didn't do too much with exponential growth and decay. I should have done more with that. We did some linear equations, not too as many inequalities I would have liked. We did some linear regression. We did BASI, natural logarithms, did a lot of percents, and we did a lot of spreadsheets and formulas and quadratic regression. All right. Feeling good about this. Feeling good about this. So yes, this is credit card statements. And oh my gosh, is there an average daily balance lesson after this? I forget. Maybe I lied. Maybe we're not moving on to. I'll have to take a look at things. Okay, this is the part where I read to you. If you want to read this on your own, you can just pause me now and then fast forward it when I get through this. But I'm going to read it for those who would rather have it read to them. What information does a credit card statement give you? Credit cards can be used when making purchases in person, by mail, by phone, online, and more. In most situations, you get a receipt for each transaction, but it can be difficult to keep track of the transactions over a billing cycle. A billing cycle is a predetermined amount of time set by the credit card company that is used for calculating your credit card bill. This cycle can be adjusted by the company based upon your credit worthiness. For example, a college student with little or no track record of being able to keep up credit card payments may initially be given a 21-day billing cycle. A seasoned credit card holder who has proven to be financially responsible might get a longer billing cycle. At the end of every cycle, the credit card company takes an accounting of your credits and debits and sends you that information in the form of a credit card statement. You should read the statement carefully and verify the charges. All credit card companies have a process through which the credit card holder can dispute errors on the statement. June Sharp has a flashcard revolving credit card. At the end of a 30-day cycle, Jane receives her flashcard statement listing all of her purchases and payments the company has received during that 30-day cycle. Jane's credit card statement is shown below. So here's like a kind of the sample credit card statement we'll be using today. And let me talk about the pieces of these. All right, the account number. Each credit card account has a unique number. Right there's the account number listed. You don't remember this is private. You don't want to give this information out. The credit line. The credit line is the maximum amount that you can owe at any time. Right here, total credit line $8,000. Available credit is the difference between the maximum amount you can owe and the actual amount you owe. So the total of available credit is right here. This person can still borrow up to $7,636.52. They have that much available credit left over. Billing date, the date the bill was written. There's the billing date, January 23rd. All right, payment due date. On this date, the monthly payment must be received by the creditor. There's the payment due date, February 2nd. Transactions. lists where purchases were made and the date. Some companies use the date posted, which indicates when the creditor received its notification of the charge and processed it, but some companies use the date of transaction, which shows when the purchases were made or payments were received. Some companies list both posted and the transaction dates. All right, so there's your transactions. They bought something at a gift shop for $75. They bought something at a pizza place for $31.85. They bought something at Beekman's department store for $139.10. And then I see on January 21st, they made a payment of $75. Notice how there's a negative there. That's important, right? That negative says they owe less money. Remember, when you make a payment on your credit card, that means you've paid off some of your debt, which means your debt goes down. But when you're making charges on your credit card, it's making your debt go up. How much you owe goes up, okay? Keep in mind that relationship there. A debit is the amount charged to your account. A credit is a payment made to reduce your debt. Credits are identified by a negative sign. That's why that negative sign is there, because that's a credit. Previous balance. Any money owed before the current billing period. So right there is previous balance, $150.50. Right, that's the amount that she carried over from the last month. Payments and credits. The total amount received by the creditor. So that's all her payments and credits. She only made that one $75 bill or payment. So that's all the payments and credits total is $75. New purchases is the sum of purchases, debits on the current bill, right? There's the new purchases, $284.45. How'd they get this number of new purchases? They added up all these charges that she made here. If you add up 75 plus 31.85 plus 139.10 and 38.50, if you add up all those, you will get $284.45. Late charge. There's a penalty for late payments from the current month. A late charge here is $0, which means she must have paid on time last month. Finance charge, the cost of using the credit card for the current billing period, right? You know how to calculate finance charges by now. You know how that works. The new balance is the amount you currently owe. So the new balance is the amount you currently owe as of this statement, right? As of the statement billing date of January 23rd. The minimum payment is the lowest payment the credit card company will accept for the current billing cycle. Usually it's $20. If you owe a lot of money, that can go up. It can go as high as, well, I don't know how high it could go, but it can go up pretty high if you carry a big balance on your credit card. Let's see. We did an average daily balance, the average amount owed per day during the billing cycle. We spent a lot of time calculating average daily balance manually. Here it is done by the credit card company. It's on your statement. This is what the number they use to assess the finance charge, right? Which is based on the APR, which is based on the monthly periodic rate. Number of days in the billing cycle, the amount of time in days covered by the current bill. There's the billing cycle. This one's 30 days. APR is the annual interest rate, and monthly periodic rate is the APR divided by 12. That's the summary of this credit card statement. Okay? This stuff should be pretty easy once you get to it. Example 1. Whew, I just need to take a breather. Okay. The summary portion of Jane Sharp's credit card statement shown on the previous page looks as follows. So this is the summary portion. Remember this piece right here, the summary portion. Explain how the new purchases amount was determined, and then explain how the new balance amount was determined. How would you do this? How would you explain how the new purchases amount was determined? Well, define the new purchases amount. That's the sum of all the purchases that appear as debits. The sum equals $284.45 because they added up these four things here, right? 75, $31.85, $1.85, right? They're adding up each one of these charges. They add them all up. 284. That is new purchases. New purchases is adding up all the charges made in that month. Note that in new purchases does not include the payment made. That's going to get counted in payments and credits. All right. Sorry. There we go. Okay. B is explain how the new balance amount was determined. Well, the new balance amount is determined by using the formula given below. The important thing here is just to notice that nearly everything is getting added except for payments. Payments and credits is the one thing that's getting subtracted from all this. So if you just remember previous balance, new purchases, finance charge, late charge minus payments is the new balance. You're good to go. You're good to go. All right. So you take the previous balance, and remember you can as long as you think of this as a negative, you can just kind of add all these things together. And it doesn't matter what order you do these things in. All right, so 150 and 50 cents minus payments plus new purchases plus the finance charge plus the late charge equals $363.48. So you'd say, I found the new balance by taking the previous balance, subtracting the payments, adding new purchases, adding the finance charge, adding the late charge. That's the new balance. All right. Okay, practice. Write the spreadsheet formula for cell F2. This is cell F2 right here. You give me a spreadsheet formula, all right? I'll give you a second, and just pause the video here and give this a shot. Great, through the magic of video, you paused me, I shut up for a second. I know, amazing, right? And we're gonna do spreadsheet formula. Remember, a spreadsheet formula starts with an equal sign, all right? Starts with an equal sign. All right, and remember the formula is previous balance minus payments plus new purchases plus finance charge plus late charge. So here goes. Previous balance is A2. So it's A2 minus payments, so minus B2 plus new purchases plus C2, right? Plus late charge plus D2 plus the finance charge plus E2. That wasn't so hard, right? You just did a spreadsheet formula. Yay! You know, those of you who hate these are hating me right now. Okay. Example 2. Pascal. Pascal has a credit line of $15,000 on his credit card. His summary looks as follows. How much available credit does Pascal have? All right, there's the summary. Here's his previous balance. There's his payments and credits. There's his new purchases. There's his late charge. There's his finance charge. In order to find out how much available credit Pascal has, we will first need to calculate the new balance. That's what we did up here. We just calculated the new balance, right? So we'll have to take the previous balance minus the payments and credits, plus the new purchases, plus the late charge, plus the finance charge. It'll give us new balance. Once we have the new balance, we take the credit line, subtract the new balance, and we get the available credit. Okay? So here goes. We're taking the previous balance. We're subtracting the payments and credits. We're adding the new purchases, right? Right? We're adding the late charge, right? Right? We're adding the finance charge, yeah, yeah. And then we get $1,992.45. Okay. Woo. Now that we have this number here, this is the new balance, and we take the $15,000, we subtract the new balance. So it's not showing you this step, so seeing is believing sometimes. Here's my $15,000. I have to subtract my new balance, $1,992.45. And then I get, $13,007.55. This is the available credit. We've calculated Pascal's available credit. All right. So here's your turn. Here's your turn to try these. Maybe you want to pause me here and try the next, everything with this credit card picture there. Go all the way down to this, stop at Rhonda and maybe turn me back on, okay? Give these a shot. I think you got it. All right, the magic of video. You were able to pause me, make me be quiet for a second, and you answered a few of these. So let's just talk about them. How many purchases were made during the billing cycle? Well, the purchases are the debits, right? It's everything with a positive number. I just count them. 1, 2, 3, 4, right? Quattro, 4. 4 payments were made. What is the sum of all purchases made during the billing cycle? All right, now you could add all these up, but perhaps you already know that new purchases is adding all the all the purchases made during the billing cycle. So it should be $284.45. That should be right there. And you could have figured that out by adding them all up, right? You could have taken $75 plus 31.85 plus $139.10 and $38.50. right? $284.45. Beautiful. All right. When is the payment for this statement due? When is the payment due? Well, hopefully you looked at this and you said, oh, February 2nd. Payment due February 2nd. Yeah, all right. That's what should go in there. What is the minimum amount that can be paid? Minimum amount that can be paid. That's the minimum payment. And hopefully you see here in the lower right-hand corner, there's the minimum payment, $20, right? How many days are in the billing cycle? How many days in the billing cycle? Well, you scanned this and you saw this. Number days, pound day, that means number days in billing cycle, 30. 30. What was the previous balance? You scanned the credit card statement you saw. Right there it is. Previous balance, $150.50. Okay. All right. So just a couple more questions left. All right. If Rhonda had a previous balance of $567.91, and Rhonda made an on-time credit card payment of $567.91, and if she had a credit line of $5,000 and made purchases totaling $1,000, what is her current available credit? How do you solve this? Step one, find the new balance. Step two, take the credit line and subtract the new balance, and you'll have the available credit. All right, you want to probably pause me and give this a shot. All right, good. Good on you for giving this a shot. It's really important to try these on your own. If you just wait for me to show you how to do them, you won't learn as much. All right, it's really, really important for you to try these on your own. Even if you're like, I don't know what to do, and you just type random numbers in here, at least your brain is like trying to desperately to find an answer, and your brain is working. And even though it doesn't feel like you're learning, you learn through struggle. You learn when it's difficult. All right, so good on you for giving it a shot. All right, so new balance. So New Balance. All right, let me just kind of like scroll back up and remind us what a New Balance is. It's right here in example two. No, actually, this is example two is exactly showing us how to find available credit. Actually, I'll use this one, right? So the first step was we found the new balance. We took the previous balance, we subtracted payments and credits, we added new purchases, we added the late charge, we added the finance charge, we got the new balance. Then we took the 15,000 and subtracted the new balance to find the available credit. That's what we're going to do right over here. Here goes. The previous balance was $567.91. The payments were 500. Oh, they were exactly equal. So I subtract 567.91. Now I have to add. What do I have to add? I have to add all the new purchases. New purchases totaling $1,000. There's new purchases. Then I have to add finance charge. Doesn't say there's any finance charge, so add zero. I have to add a late fee, so I have to add a zero. I don't see a late fee here. All right. Was there anything else? I think that's it. All right. Press enter. $1,000. Okay. So now the available credit line is, I'm sorry, the credit line is 5,000. 5,000. Subtract the new balance, and we get the available credit, $4,000. All right. That wasn't so hard, really. All right. And I'm actually going to have you take care of this one here. I'm going to have you do this one. This is going to let me know whether you get it. Jason has a credit card with a line of credit of $9,000. He made the following purchases. Okay, $485.36, $328.93, $397.11, and $95.25. What is Jason's available credit? I guess assume a previous balance of zero, assume a finance charge and late fee of zero, and yeah, and assume the credits are zero. So I think you can handle that. Okay, complete the learning. Yeah, answer the question about how you feel like you're doing on this learning target, and then click the submit button. And whoo, you're done. You're done. All right. Thanks for joining me today. Hopefully you found this video useful, and I'll see you in class.